Welcome to the deep dive. Today we're jumping right into something fundamental, really the bedrock of modern financial reporting: financial assets and financial liabilities.
Yeah, we're moving beyond, the tangible stuff like factories and inventory.
Exactly. We're talking contracts, rights, obligations, the stuff that actually drives a lot of value and risk today.
And our mission here really is to unpack why we needed these complex global standards, things like IFRS 9. Because the world of finance just exploded with complexity, didn't it? Derivatives, swaps, options.
hmm
And the old rules, well, they left too many gaps. Companies could kind of hide losses or gains, unrealized ones especially. These standards are trying to force discipline. It's all about substance over form.
Substance over form. I like that. Okay, let's start with the basics then. What is a financial instrument at its core?
It's actually quite broad. It's any contract that results in a financial asset for one entity
Okay.
and then a corresponding financial liability or an equity instrument for another entity.
So it's always two-sided, a contract creating that link.
Precisely. And the need for standardization, it just became overwhelming. Without it, you had companies picking and choosing accounting methods to, let's be honest, sometimes smooth out profits or delay bad news.
Right, managing the earnings number.
Exactly. IFRS 9 was a major attempt to clamp down on that, internationally at least.
Okay, let's hunt for that substance then. Starting with assets. Under the standards, like IAS 32, what qualifies?
Well, the obvious one is cash.
Sure.
But beyond that, it's about contractual rights. So a right to receive cash or another financial asset from someone else.
Like a trade receivable, an IOU from a customer.
Perfect example.
Hmm.
Or owning shares in another company that's an equity instrument of another entity, so it's your financial asset. Think investments in shares, bonds you hold, even options you've bought.
Got it. And the flip side, the financial liability. That's when you owe something.
That's the core of it, a contractual obligation to deliver cash or another financial asset to another entity.
Like trade payables or loans you've taken out.
Exactly. But there's a slightly trickier part, too. It can also be an obligation that you might have to settle using your own company's shares,
Ah.
but under conditions that are potentially unfavorable to you. That catches some more complex situations where you might be forced to give up value via your own equity.
Okay, and this brings us straight to that substance issue, doesn't it? The classic case. Preference shares. Sometimes they look like equity, sometimes like debt.
They're a prime example. Because the standard says, forget the legal name for a second, what's the substance?
Right.
If the preference shares are irredeemable, meaning the company has absolutely no obligation ever to pay back the capital.
They just pay dividends if they can.
Exactly. Then it behaves like equity. No contractual obligation to hand over cash means it's classified as equity.
But if they are redeemable, say the company must buy them back on a specific date.
Ah, now that's different. If there's a contractual obligation to deliver cash at a fixed or determinable future date, even if it's way off in the future.
Then it's a liability.
Precisely. That obligation to pay overrides the share label. It is a financial liability because of the substance of the unavoidable commitment to pay cash. It's debt in disguise, effectively.
That's a really clear illustration of substance over form. Okay, so we know what they are. Now, how do we value them after we first record them? IFRS 9 seems central here, setting out three main paths, right?
Absolutely. Initial recognition is usually at fair value, but what happens next, the subsequent measurement, is crucial. And yes, IFRS 9 gives us three main categories. And choosing between them, well, that says a lot about management's intentions.
And impacts the bottom line differently. Let's take the first one. Fair value through profit or loss. FVTPL. Sounds direct.
It is. It's the default for anything held for trading. And for equity investments, too, unless you specifically choose otherwise.
And how does it work?
Simple, but potentially painful. You remeasure the asset to its fair value every single reporting date. End of the year, what's it worth now?
Okay.
And the gain or the loss compared to its previous value goes straight into the statement of profit or loss.
So, market swings hit your income statement immediately. Full volatility on display.
Maximum volatility, maximum transparency in that sense. No hiding place for market movements.
Okay, then what about the second category? Fair value through other comprehensive income. FVOCI. Why opt for this?
This is more for strategic long-term investments, particularly equities that you don't intend to trade quickly. You can elect irrevocably, mind you, to classify them this way.
If they're not held for trading.
Correct. The measurement is similar. You still update to fair value each year, but here's the key difference. The gain or loss doesn't hit your main profit figure.
Where does it go then?
It goes into other comprehensive income OCI. Think of it as a separate section below your main profit, and it accumulates in a reserve account within equity.
Ah, so it affects your total equity, your net worth, but it doesn't make your reported profit for the year jump around so much with market fluctuations.
Exactly. It keeps that short-term noise out of the main performance metric until you actually sell the investment. Then, accumulated gains or losses might be recycled to profit or loss, depending on the specifics. It definitely smooths the reported profit.
Interesting. Okay, category 3, amortized cost. This sounds maybe less exciting, but you mentioned it's actually quite tough to qualify for.
It is because it offers the most stability in terms of reported values. So IFRS 9 puts up two significant hurdles, and this method is mostly for debt instruments, like loans or bonds you hold.
And the hurdles are?
First, the business model test. The company's objective for holding that debt asset must be simply to collect the contractual cash flows over its life. You're holding it to maturity, basically.
Not planning to sell it early for a gain.
Right. If your model involves active trading or selling before maturity, you fail this test.
Okay, that seems relatively straightforward. What's the second test?
This one's trickier. The contractual cash flow characteristics test, often called the SPPI test,
SBPI.
stands for solely payments of principal and interest. The actual terms of the contract must only generate cash flows that are, well, purely repayments of the principal amount loaned, plus interest representing the time value of money and credit risk.
So just basic loan features. Nothing fancy.
Exactly. If the contract includes weird features like interest payments linked to the borrower's share price or some kind of embedded option or derivative,
Then it fails the SPPI test.
correct. Because the cash flows aren't solely principal and interest. The standard views those instruments as more complex, potentially riskier, and says, nope, you can't use stable amortized cost. You probably need to use fair value, likely FVTPL.
So amortized cost is really reserved for your plain vanilla loans and bonds, where you just expect to get your money back plus standard interest.
Pretty much. It keeps things simple for simple instruments.
And the calculation itself.
Yeah.
How does amortized cost work? For a liability, you said it's initial value plus effective interest minus interest paid.
That's the essence of it, yeah. The key is that effective interest. It's not always the same as the coupon rate stated on the bond.
Ah, okay. Like with a deep discount bond.
Perfect example. Say a company issues a bond with a face value of $10 million, but only receives $9 million in cash up front. And maybe the coupon, the annual cash interest paid, is quite low.
Right.
The company really borrowed $9 million and has to pay back $10 million, plus the coupons. The true cost of borrowing includes that $1 million discount, maybe some issue costs too.
So you can't just expense the low coupon payment each year. That wouldn't reflect the real cost.
Exactly. You calculate the effective interest rate. That's the rate that perfectly discounts all the future cash payments, coupons, and the final principal repayment back to the initial $9 million received. It'll be higher than the coupon rate.
And you use that rate to calculate the interest expense each year.
Yes. So the interest expense recognized in the P&L reflects the true economic cost of the borrowing, spread evenly over the bond's life. Again, substance over the superficial coupon rate.
Makes sense. Okay, moving on to something definitely not plain vanilla. Compound instruments. Convertible debt is the classic here, isn't it?
Absolutely. This is where the standard mandates split accounting right from the start. You've got one instrument, a convertible loan note, say, but it has features of both debt and equity.
Because the holder can choose to take repayment in cash, like normal debt or...
Or they can convert it into a fixed number of the company's ordinary shares. That's the equity option.
And why would a lender accept this? Usually it means they take a lower interest rate, right?
Well, often, yes. They sacrifice some guaranteed interest income for the potential upside if the company's shares do really well. That conversion option has value.
So the standard says you have to split this single instrument into two pieces on day one. How?
Yes, you have to separate the liability element from the equity element. The crucial first step is to value the liability part.
How do you isolate the debt part from the equity option part?
You figure out the present value of the contractual cash flows, the interest payments, and the final principal repayment, assuming no conversion happens. But, and this is key, you discount those cash flows using the interest rate the market would demand for similar debt without any conversion option.
Ah, so you find the market rate for pure non-convertible debt with the same risk profile.
Exactly. That gives you the fair value of the pure debt component at inception.
Okay, so that's your liability number. What about the equity part, the value of the conversion option?
That's simply the residual. It's the total cash proceeds the company received for issuing the convertible debt minus the fair value of the liability component we just calculated.
So proceeds minus PV of liability, equity component value.
Precisely. That equity component is recorded in equity, and importantly, it's not remeasured later. It just sits there until the bond is either converted or redeemed. The liability part, though, that gets accounted for using amortized cost, just like regular debt.
Fascinating. So you really carve it up based on economic substance. Okay, last big area, getting these things off the books, derecognition.
Right. When do you remove an asset or liability from your balance sheet? For liabilities, it's pretty straightforward.
When you pay it off.
Essentially, yes. When the obligation is discharged, canceled, or it expires, done.
Assets seem trickier, though.
Much trickier. You derecognize a financial asset only when your contractual rights to its cash flows expire or when you transfer the asset.
Like selling it.
Yes, but here's the catch. You must also transfer substantially all the risks and rewards associated with owning that asset. That risk and reward transfer is the absolute key.
And this brings us to things like factoring receivables, doesn't it?
Yeah.
Selling your customer invoices to a third party.
A very common scenario where this test bites. A company needs cash, so it sells its trade receivables to a factor. The factor usually pays the company upfront, maybe 80–90% of the face value, and handles collection.
So the big question for the accountant is, was that a real sale or just a loan disguised as a sale?
Exactly. Can the company take those receivables off its balance sheet?
How do you decide?
It all comes down to who bears the risk if the customers don't pay up. This is the recourse aspect.
Okay, explain recourse versus non-recourse.
If the factoring is without recourse, it means the factor takes the hit if customers default. The company selling the receivables is off the hook for bad debts.
So the risk has genuinely transferred to the factor.
Correct. In that case, substantially all risks and rewards have been transferred. It's treated as a true sale. The company derecognizes the receivables and recognizes any gain or loss on the sale.
And if it's with recourse?
Now the company hasn't transferred the credit risk. If customers default, the factor can demand repayment from the original company. The company retains the downside risk.
So it's not really a clean sale then?
No. Because the risk hasn't substantially transferred, the standard says this is essentially a loan secured by the receivables. The company keeps the receivables on its balance sheet and recognizes a financial liability for the cash received from the factor.
Substance over form again. Even if the contract says sale, if you keep the risk, it's treated like borrowing.
That's the heart of it. It dictates classification, measurement, and derecognition.
Okay, so just to recap quickly, we've covered the core definitions, the three key measurement bases under IFRS 9, FVTPL, FVOCI, and the hurdles for amortized cost.
Right, especially that SPPI test.
Then the split, counting for tricky things like convertible debt, and finally, how risk transfer governs derecognition, particularly with factoring.
It maps out the core logic, and understanding this helps you, the listener, really decode financial statements. You can see the choices management is making.
Yeah, it helps you look beyond just the bottom line profit number and see how it was constructed, especially regarding volatility.
Which leads perfectly into our final thought. Think about that choice between FVTPL and FVOCI for, say, an equity investment the company plans to hold long term.
Okay.
Choosing FVOCI doesn't change the asset's actual value or the dividends received. All it changes is where the ups and downs in market value get reported year to year.
Right, P&L versus that quieter OCI section in the equity reserve.
Exactly. So what does that deliberate choice to shield the main profit for the year figure from that market volatility by parking it in OCI tell you?
Right.
What narrative is the company trying to present to its investors by making that specific accounting policy choice? It's more than just numbers, it's communication.